Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. Over the next 20-25 minutes, we'll talk about all about mutual funds, of course, but what kind of funds in a market scenario which is increasingly turning a bit choppy, uncertain at very high valuations. So the question that we asked to our guest today, and our guests today are Juzer Gabajiwala, Director of Ventura Securities, and Nisreen Mamaji, Founder and CEO of MoneyWorks Financial Services. Both of you, thank you so much for joining in. And the question that I have at the top of my mind today is that for an investor who is not an out-and-out equities person, let's say she's investing in equity markets, but she's also a bit conservative, and she doesn't have a very large risk appetite. Should that person choose hybrid funds as an SIP or a lump sum at the current juncture if the person is investing for a time period between 1 and 3 years? I think that's the principal question, because I'm sure this is the case for a lot of people who are right now getting a bit nervous with the market valuations and thinking, how do I stick to my investing policy of an SIP, at the same time mitigate the little bit of a risk? So Nisreen, I'll start with you. Are hybrid funds a good option for something like this or not really?
No, so I think for a risk-averse investor who also wants risk-adjusted returns, because if you go for a 100% debt fund, then obviously you will not be meeting inflation, and you will not be making the desired return. So therefore, I think that the option which is called the equity savings fund in the dynamic asset allocation category or in the balance category with a minimal equity allocation. So ICICI Prudential Equity Savings Fund has currently got an equity allocation of about 17%. The rest is into arbitrage. In order to qualify as an equity fund, the entire equity allocation has to be 65%, and the rest is into bonds and debt. So, for a conservative investor, I think a 17% equity allocation into long stocks would make, excellent sense, because they would definitely meet the expected return and, also meet inflation standards. Another option is HDFC equity savings, where currently the equity option allocation is about 33%. So you have the options of both. For a risk-averse investor, completely risk-averse, ICICI would be a good option. And for somebody who wants a slightly more equity allocation, you can go in for HDFC. Balanced advantage funds also would make sense for a risk-averse investor, but your equity allocation would be a little higher. So for example, if you go for Parak Parik, that's a conservative hybrid fund, and the equity allocation is about 16%. But because it comes in the debt category, your taxation would be according to the debt, funds. But you can also go in for Tata Balance Advantage Fund, where currently the equity allocation is 47.5%, or HDFC Balance Advantage Fund, which is about 51.4%. So depending on your own, risk appetite, you can take various levels of equity allocation, even in the dynamic asset allocation space. So equity savings as a category and balance advantage as a category makes excellent sense for a risk-averse investor. If you want to increase your equity allocation, you can go, for a balanced fund, which is 65% equity and 35% debt. So there's a range of products here that will definitely meet your, risk tolerance and as well as give you risk-adjusted returns.
Okay. Well, in some sense, Nisreen has made the rest of the show pointless, because she's given just the right answer that you would actually need. But Nisreen, thank you so much. Yeah, this is great to know. Viewers, what I'm going to do is, now usually the climax happens at the end in a movie, and you set the stage for the climax. We've had a bit of a climax right now. Now we're going to go back. So let's say we've done the movie. Now we're going to go to a prequel, if you will, and try and unwrap this as well. But let me first take an initial comment from Juzer Gabajiwala as well. Juzer, and viewers, what we're going to do is, after Juzer's answer, I'm going to try and tell you the different kinds of hybrid funds available and what kind of hybrid funds might be suitable for what kind of an investor. We'll try and probe that a little bit as well. But Juzer, initial thoughts from you. The same conditions. She's a risk-averse investor, wants to invest for 1 to 3 years. Are hybrid funds a good alternative?
So I think, as you have said, Nisreen has already covered up the entire thing. So doesn't give much scope for me to add much, because
Juzer, there is. Looking forward.
So my take is that I think the most important aspect which any investor should look at would be is that he has to beat inflation, and not only beat inflation but consider taxation as well, right? So I think a bank FD generally does not give that, and that's one of the reasons why we have been seeing many of those banks have been clamoring about that they are losing deposits. So having said that, equity savings as a category does resonate for an investor who is doesn't want to take too much of a risk. Now the only question would be is that when you are looking at a time horizon of 1 to 3 years, and you also talked about that whether the person should do it as a one-time investment or whether he should do it as an SIP. Now, ideally, it would make more sense to put it more as a lump sum. For the simple reason is that if your time horizon is 3 years, and if you start doing an SIP, your average holding will be, just around 18 months. Okay. So, and if your time horizon becomes 2 years, then your average holding is just around a year. So I think putting more as a lump sum would make more sense, and specifically equity savings have the benefit of the advantage of it, the having equity taxation with a 1 year holding. Some of the multi assets can also do well, specifically like how we have White Oak multi asset and Edelweiss, where equity exposure is fairly negligible. Plus, you also have gold also coming in as a play over there. So only thing over there, the holding period should be 2 years to qualify for long term. So I think all in all, multi-asset and specifically equity savings. Only one thing is that a person will have to be very mindful about, because the asset can keep on undergoing a change. The equity component can undergo a change. So an investor will also always have to be mindful about what is the disclosure which is made and what is the equity allocation. In fact, one more option which a guy can consider is also, like Quant has a dynamic asset allocation where he can actually go up to zero if the market become extremely expensive. So you need to start looking at what each fund has as a part of the DNA. So that is what my take would be in terms of the
Got it.
investment strategy.
Okay. No, okay. So we've gotten the main answers from both our guests. Let's now try and make it a very basic conversation for me and you, my viewer, to understand these different kind of funds. So, okay, Nisreen, I'll start with you. Correct me on this. Or Juzer, I'll start with you on this. Correct me on this, okay? But the types of hybrid funds available. So equity savings, conservative and aggressive hybrid. Do multi-asset class funds also qualify as hybrid? I would reckon they do, but please correct me if I'm wrong. Some bit of dynamic asset allocation and maybe even arbitrage funds. Would this be the gamut of of hybrid categories available in India currently, or are there more?
No, I think yeah, these are the ones which would, in fact, I would not call arbitrage, purely as a
Hybrid.
hybrid. I mean, I would actually compare more with more like a short-term debt fund or a slightly longer duration liquid fund.
Fair.
So apart from that, I would actually look at equity savings, conservative hybrid, aggressive hybrid, and multi-asset. And in fact, to a certain extent, some of the asset allocator funds will also come in also as a part of the strategy in terms of hybrid as a category.
Got it. Now, Juzer, for somebody who is risk averse, but as Nisreen described it beautifully in her answer, but wanting a slightly better than what debt fund return gives, because frankly, getting the debt fund return to an extent also for a young investor is pointless because it doesn't quite beat inflation, right? Especially inflation as it picks up. So my question is, within this set of hybrid funds, which are the ones which maybe with a slightly higher risk profile give you the best returns?
So I think with a slightly higher, if you actually go to see, would be your balance advantage funds are the ones which could give you a higher return, and even it could be to a certain extent even multi-asset. In fact, some of the multi-asset funds have actually outperformed even quite a few of the equity funds as well. So In fact, that as a category is also a good category, specifically if in the today's time when the markets are slightly on the upper end, and since gold is also a good combination over there, so minimum 10% allocation is given, has to be in multi-asset into precious metals. So gold and silver by default 10% lands up being as an allocation. And like specifically we like the white oak type of fund because his allocation to gold is nearly around 20 odd percent, plus the equity exposure. He'll also be able to add in international equity over there. And with even the definition of in income tax undergoing a change now, specifically from 1st April 25, where it only requires more than 65% allocation towards debt, for it to be classified as a debt fund. Otherwise, with a 2-year holding time horizon, everything has become equal in terms of even the tax rate. Like you still will pay 12.5%. Now, whether you hold equity, it is 1 year 12.5%, and whether if you hold a multi-asset like a white oak, it will be 2 years with 12.5%. So tax rate wise, you'll become more or less neutral.
Okay, okay. Some examples out there too. Thank you, Juzer, for that. Nisreen, for somebody toying between equity savings funds versus other categories, I would love for you to tell us what are equity savings funds and why would they be the right fit for somebody who wants to earn that slightly better than a debt return profile with a lower risk appetite?
Sure. So basically, an equity savings fund would be termed as equity for taxation purposes. Therefore, the entire asset allocation towards equity, whether it is long or whether it is arbitrage, should be 65%. So for somebody who wants to have a lower, risk appetite and who wants a lower exposure towards equities, in the equity savings category itself, they can go in for something like ICICI Prudential or PGIM, which has about 11 to 15% of equity, and the rest, in arbitrage to complete the 65% quota, and the balance 35% would be in debt. So equity savings itself, just by the name, is basically, there are two choices in the dynamic asset allocation category. There's BAF, which follows a similar strategy, which is balance advantage fund, and equity savings also, which follows the same strategy. Equity savings would typically have a lower asset allocation. So before you invest into either equity savings or a balance advantage, it's important to check what is the exact equity allocation that you are going in for. If you wish to take a higher equity exposure, then you should know whether you want to take 30%, 40% or higher. So the risk basically is for you to be very clear, not by the name itself, but by checking the exact proportion or allocation towards equity and towards arbitrage in the equity savings or the balance advantage category. And there you will be able to match your own risk tolerance with the fund itself. So if you are expecting to be having less volatility, then definitely equity savings fund would be a good option for you. 15% to 11% would be ICICI Prudential equity savings or PGIM also. If you wish to go in for a slightly higher asset allocation, then you can go in for a BAF, either Tata or HDFC, which has in the range of about 50% plus towards equity and 15% towards arbitrage and the rest in bonds. So the hybrid as a category, you can go in for either conservative or aggressive. Conservative hybrid would have a higher debt allocation, less of an equity allocation, at least 65% in debt, but an aggressive hybrid combination would be 65% in equity and 35% in debt. So here in the hybrid category, you may not have much allocation towards arbitrage. It could be directly long equity and debt. Right. So basically, it's important for the investor to check the allocations. Yeah.
Got it. Nisreen, what kind of returns should one anticipate? Let's say if somebody invests in these equity savings funds, the two that you recommended, or some others as well, what are the average kind of returns that somebody should anticipate?
So if you have a lower equity allocation, like I said, the Prudential or PGIM, you should expect in the range of 9 to 10%. Okay. Of course, they have returned higher, depending on the market in the last 3 years. But as far as expectation goes and as far as prospective returns go, you should be looking at about 9% averagely. I think that would be a good way to start. And the higher the equity allocation, higher the volatility, of course, and higher the return expectation. So that can go up to about 11 to 12% if you're going in for a balanced advantage fund with about 50% direct equity allocation.
Got it. Juzer, I have one more question for you, and then we'll try and take a couple of queries. In fact, there are two or three, there are maybe actually multiple ones, but we'll probably try and take two or three. But what kind of investor should choose the aggressive hybrid category? What are these? What kind of investor should choose these? And what are the kind of returns that one should anticipate?
So it's basically like we normally, investors who are looking at, more than, equity as an investment. And, when they say that the time horizon, we normally tell them five years plus, right? And if the time horizon is not 5 years and they are looking at, somewhere around 3 years plus, and they are not very sure after 3 years whether they would need the money or not need the money, right? So then for them, aggressive hybrid makes more sense because he has a 3 year plus time horizon. And specifically in the current market environment, even for any investor coming for equity, we still tend to suggest more of a aggressive hybrid or multi-asset, since specifically when the valuations are high. So, because most of the investors are expecting that whatever the returns are there in the past, the same thing will get, carried forward in the future. And I think we may look at a reversal back to the mean. We are seeing, aggressive hybrids giving nearly 18-19% return, whereas long-term average equity return itself, we talk about 15%. So I think, as we can see itself, type of equity and debt is giving around in 3 years aggregating 22%. Now those are the type of returns which one cannot expect going forward. So I think expectations will have to be set lower, and that's why aggressive hybrid today looks much better for even an investor who's looking at pure equity as an investment.
Juzer, did I miss the fund names or any recommendations that Ventura Securities might have in this category?
So we like HDFC Balance Advantage. Because we have seen that the way the equity allocation is going, so now they have been high around a year back, and now they have come down in the equity allocation. So that looks pretty good. Specifically, it resonates with the way we are also looking at the market. That with a lower equity exposure, if you can get a better alpha generation, then it's quite good. ICICI Prudential equity and debt is also doing pretty well. And the other one which we like is also quant dynamic asset allocation. Simply from the point of view that the risk adjustment management is done very aggressively at quant.
Okay, so a few names. Quant Dynamic Asset Allocation Fund also features in that list from Juzer Gabajiwala. So on the aggressive hybrid side, and viewers, I hope you because we got the main answer at the start. I was just trying to unpack what each of these categories might be. So a very basic conversation, but something that might help you understand what are the kind of returns anticipated from each of these categories. Remember, relative to pure equity funds, this would be a lot safer in terms of if the markets were to correct, so on and so forth. But the returns as well relative to pure equity funds would be a lot lower. But they are meant for that kind of an investor or that kind of a time wherein maybe returns are not very predictable and you need some safety as well of debt instruments, which probably the hybrid funds would provide. Just one quick 30-second answer each from both of you before we take in the queries. Nisreen, to you first. Would you at the current juncture have a preference for hybrid versus pure equity funds? 30-second answer.
I think I would, because in times of volatility, I would definitely recommend dynamic asset allocation, so that the risk is managed.
Okay, Juzer, would your view be the same? It could be different, of course.
No, absolutely. What she said is absolutely right. I would rather, in fact, I would even look at multi-asset because I like precious metals also as a part. So there by default I get a 10% allocation plus equity. So multi-asset is an aggressive hybrid is the way for me.
Fair call. So I'm okay. So viewers, both our guests, experts, look at mutual funds and investing day in, day out, are now talking about putting in your incremental money at the current juncture into maybe hybrid funds as opposed to pure play equity funds. because of a variety of reasons. Now, if you are a very high risk investor, you may choose to ignore this. You may sit with maybe a year of lower NAVs as well, if indeed the markets were to correct, if you really have a long-term horizon. I'm guessing, I'm not going to ask them, but I'm guessing that if I give them a 7-year, 10-year horizon, they might tell me that in which case an SIP into pure play equity funds is also okay. But for now, because I've given them the time frame of 1 to 3 years, they're choosing hybrid funds over pure play equity funds at the current juncture. It may change with the market texture in the next few months. But I have time for 2 queries, and I'm going to shift to that. Uday Pete, age 37 years, has this query. Juzer, I'll start with you on this. Uday says, I'm a new investor and want to invest 15,000 rupees per month. My target is 1 crore. How much time will it take, and what are some of the funds that I can invest in?
Okay, so it's a the general thumb rule. If we follow a 15% return, right? So it takes 15 years at 15,000 to have a target of 1 crore, right? And if you, I think since his horizon, I'm assuming that it will be longer because he would then invest for at least a 15-year time horizon. So he can look at equity funds as a part of his target. And the best bet would be is have 1 large cap fund, 1 mid cap fund, and 1 small cap. So I think that's what he can do. So my preference would be is that one, he can look at Nippon large cap, he can look at Kotak Emerging for mid cap, and Bandhan small cap fund.
Okay, can we, if we have those fund names, if we can just put it out for Uday to know. Juzer, could you just please repeat the fund names as well? And should the allocation in these funds be equal or should they be varied?
No, it can be equal. I mean, since he's got a 15-year time horizon, so it beats our benchmark of everything in terms of holding even a small cap for a longer time duration. So I have recommended is Nippon large cap fund, Kotak Emerging for mid cap, and Bandhan small cap. So he will basically be invested across the gamut of the market.
Got it. Now, Uday, I hope you got your answer, because I certainly did if I was you. I would, however, recommend you, Uday, if you are not completely sure of where to go in, it's always good to come to us. We try and give you the answers. It's also good to have somebody hand-holding you through this journey as well. Please keep that in mind if you're completely unsure of what to do. However, Juzer's answer should hold you in good stead if you are a systematic investor investing for the really long term, and don't get flustered if returns change a little bit here and there in intermediate periods of market correction. Nisreen, a question coming in from Tanvi Bide. Tanvi is aged 29 years. Tanvi asks, what are some of the best international funds one can invest in? She says, I'm seeking more exposure to foreign stocks such as Nvidia and other semiconductor stocks. Do you have a view here, Nisreen?
Definitely. So, definitely, Tanvi, you can go in for international funds. Typically, we suggest that your entire portfolio should be, skewed 10 to 15% towards international funds. But since you specifically asked about this, I will answer you. So, the top funds that you could be investing is Mirae Asset, NYSE, FANG, and ETF fund of funds, Kotak Nasdaq 100 fund of funds, Bandhan US Equity fund of funds, and Motilal Oswal S&P 500 index fund. Now, the stocks that you will get amongst these 4 mutual funds would be Microsoft about 9.4%, Nvidia, which you've specifically asked for, 9.37%, Amazon 7%, Meta Platforms 5.3%, Eli Lilly 5.17%, Apple 4.85%, Alphabet 4.78%, and there's another semiconductor stock, Broadcom, also about 3.49%. Netflix 2.88% and MasterCard about 2.47%. So we've tried to give you as much of semiconductor as possible. I'll repeat the name of the funds again. Mirae Asset, NYSE, FANG plus ETF fund of funds, Kotak Nasdaq 100 fund of funds, Bandhan US Equity fund of funds, Motilal Oswal S&P 500 index fund.
And Nisreen, I presume that she should invest in all of these funds and the allocation should be equal?
Yes.
Okay.
Invest in all these funds equally. And that's how we've, I've given you the semiconductor funds that you specifically asked for, the totals of all that. as well as Amazon, Netflix, Microsoft, etc.
So helpful. It's been great talking to both of you today because I understood so much about hybrid funds, and I'm sure our viewers who had queries or may have wanted to know where to invest have gotten a direction as well. Viewers, I still urge you, we get the best guests on the shows, but if you're unsure about where to invest in, please do consult a financial advisor as well. But Nisreen, Juzer, thank you so much, both of you, for joining us and giving us your views. Really appreciate your time.
Thank you, Neeraj, for inviting me. It's a real pleasure. Thank you.
Yeah, most certainly. The pleasure was entirely ours. And viewers, that's all that we have on this leg of the Mutual Fund Show. Stay tuned to NDTV Profit.